Hello guys, welcome all. I'm your host, none other than Deko Mohammed. Today I want to talk about partnership, income statement for partnership, and also the current account and the capital account. Sometimes you will be told there is an admission of partners. Previously there were 3 partners, maybe they added 1 partner, that becomes 4. Now what happens when a new partner is introduced? So whenever we have a new partner, they pay what we call goodwill. Whenever we have a new partner, they pay what we call goodwill. Now this goodwill that the new partner will pay will be shared by the previous partners on the previous sharing ratio. But whenever we are setting off this one, whenever we are setting it off, it will be shared by the new partners in the current ratio. So let me first begin with the current account and the capital account, then I will come back to the income statement for the partnership. So whenever we have a new partner, let's say here we have 3 partners. Let's say we have 2 partners, Ali and Hassan. So let's say these are the 2 partners that we have. We have Ali and Hassan. And let's say our account starting from January to December 2022. January to December 2022. Maybe as from June 2022, we admitted, let's say, Aisha. Now, when we admit Aisha June 2022, that means there will be 3 partners. Previously there were 2 partners. Let's say the previous ratio was 2 to 1, and now we can say it is 2 to 2 to 1. Now, whenever we are accounting for partners current account and partners capital account, the new partner will pay goodwill. Now, for this case, Aisha will pay a goodwill, and whenever she pays a goodwill, that goodwill will be shared by these 2 partners in the previous sharing ratio profit. For example, let's say we have goodwill that Aisha paid was 2 million. So if the goodwill is 2 million, let's say Aisha paid a goodwill of 3 million. If she paid a goodwill of 3 million, now we are going to have a goodwill account. When we have goodwill account, this 3 million will be shared by the previous partners. We are going to debit whenever we have a goodwill, it will affect 2 things: the goodwill account and the partner's capital account. Now, let's say the goodwill was 3 million. That means now this goodwill will be shared by the 2 partners, which was Ali. Ali will get 2 over 3 times 3 million. That will be 2 million. And Hassan, you will get 1 over 3 times 3 million. That becomes 1 million. Now, this is the debit entry. The credit entry will go to the partner's current account. It will go to the partner's capital. So not current, but partner's capital account. Partner's capital account. Whereby we have here the details. Let's have the 3 partners. We have Aisha, we have Ali, we have Hassan, and we also have Aisha. So this is the debit. Then we are going to have the details. We have Ali, Hassan, and then Aisha. Now this goodwill that will be shared by the 2 partners, we are going to debit the goodwill account, and we are going to credit the partner's capital account. So we say here, this is goodwill. And when it is being received for the first time, Aisha will not receive because she is the one paying. Now will be received by the 2 partners. This comes 2 million and 1 million. Yes. Now, in the case when we are setting off the goodwill, it will be shared by the 3. When we are closing this goodwill now, it will be shared by the 3 partners. Now we are going to have Ali, Hassan, and then Aisha. These are the three partners now. When she pays for the first time, it will be shared by the two partners. But when we are setting off in the final year, it will be shared by the three partners. Now, Ali will get, with the new ratio, will be 2/5 multiplied by 3 million. Hassan will be the same, 2/5 by 3 million. And Aisha will be 1/5 by 3 million. Now if we get 2/5 times 3 million, it is 1.2. This is 1.2 million. This is 1.2 million. And for the other one, it will be 600. That is around 0.6 million. Now, this is a credit entry. Now, the debit entry will go to the partner's capital account. We come and say here, goodwill. Ali is 1.2 million. Hassan is 1.2 million. Aisha is 0.6 million. What I did is that now we have closed the goodwill account. Whenever we introduce a new partner, he or she will pay a goodwill. That goodwill will be shared by the two partners in the previous sharing ratio by debiting the goodwill account and crediting the partner's capital account with the previous sharing ratio. Now, when we are closing the goodwill account, it will be shared by the three partners in the new ratio. The three partners in the new ratio. Now we are done with the goodwill. And also, for this capital account, now you are going to have the balance carried down. Because obviously here, you also have the balance brought down from the statement from the trial balance. You write the balance brought down. If the balance brought down were having positive values, they will come in the credit side. But if they are having a negative side, they will come in the debit side. Now we are done with the partner's capital account. Now that will be the case for the partner's capital account. You only have the balance brought down and the goodwill. These are the things that will affect our partner's account, and that means now we are going to have the balance carried down. To balance the two accounts, the balance carried down. Now the other current account, the other account is partner's current account. We will have the partner's current account. So you can have it here. Partner's current account. Partner's current account. For this partner's current account, we also going to have details. We have Ali. We also have Hassan. And then we have Aisha. Then we have details. We have Ali, Hassan, and then Aisha. Now for partner's current account, the first thing you record is the balance brought down. Balance brought down, you have it there, you record there. Now the next thing that will affect the partner's current account is the interest on capital. This is the credit side, interest on capital. So you have the interest on capital. This will come in the credit side, the interest on capital. Then for the partner's current account, the debit side will be drawings. If you have a drawings, you come and debit here. You come and debit the drawings. Other thing that can affect the partners, and if there is any profit share, profit will come in the credit side. Profit share. Remember, this interest on capital will be based on the capital you have gotten there, but it will be on the first 6 months. You get the interest on capital for the first 6 months and interest on capital for the next 6 months. Now let me talk briefly about the income statement. Remember, for the income statement, you're going to have 2 columns, the first 6 months and the next 6 months. For the first 6 months will be the previous partners, the 2 partners, and the 6 months will be the 3 partners. Now, when we come to income statement, we normally have, they normally say sales, like income or profit will be based on the sales. That is how you'll be told. Maybe you will be told the income will be apportioned based on the sales, and expenses may be on time due. If you're told like that, it means the sale ratio. If the sale, let's say the sales were 10,000 to 15,000, then you get the sharing ratio. You simplify this by 5 to 3. That means now the ratio will be 5 to 3. All your income you get them 5 to 3. Now, if we talk about here the income statement, we normally have the sales, but you have the first 6 months and then the second 6 months. The first 6 months will be the 2 partners, but the next 6 months will be the 3 partners, because Aisha was introduced on June 2022. Before June 2022, we had Ali and Hassan. That will come in the first 6 months. But in the next 6 months, there will be the 3 partners. Now, if you have here, normally we start with the sales. You get the sale for the first 6 months and the sale for the next 6 months, using this ratio. If they are told that the sales will be on that ratio, you simplify and get the sales. From this sales, now you less the cost of sales. Now this cost of sales will consist of the opening stock. We have the opening stock, we have the purchase, and then we less the closing stock. Now this income you get, you come and will have the sales for the first 6 months, the second month, 6 months, then you have the total. Now you less the sales, the cost of sales, the opening stock, the purchase and closing stock. You come and write here the total, and then you look the question. What are they saying? If they say expenses will be computed on based on time due, it means now you get the half. Now you divide this by 2. You write here the cost of sales, Then you get here gross profit, and then you use the ratio which was using for the sales, like 5/3, 3/5, and you come and compute them here. The same case if we have other incomes, all the income that we have, you come and record them here, and you apportion them based on the income ratio. Then you less expenses. Now for these expenses, if they say it was based on time due, it means you just get the half of them. Maybe you have salary and wages. You come and get the half of that, the first 6 months and the next 6 months. Maybe there was depreciation, you do the same. You do the same for all those expenses, and then from that you get your net profit. And then this net profit, if they ask you appropriation, then you come and say you less the interest on capital that you computed there, and then you get the profit share. That profit share will be used in the current account. Now that's all about the income statement. I'm going to do a question on this. This was just beginning to show you the workings when we are computing the goodwill, current account, capital account, and the income statement. Thank you for watching. I'm your host, Deco Mohammed.